This one is the C. We have borehole, security wall, water tanks. Such are the one that we give capital allowance at the rate of 50%, 25% under the manufacturing. So now that we are done with manufacturing, we go to number 2. Still, those at the rate that we had indicated up there. So these are the following items used in farming. The key thing, farming. So if you are doing farming, or a business is doing farming, and it incur the following costs, it should claim capital allowance at the rate of 50%, then 25% when they are determining the taxable income. What are those items? These are the one under farming. A, we have farmhouse. Now, for the farmhouse, it is very important for you to note that, I'll put it into bracket, note, only a third of the costs qualify for partnerships and sole proprietorship. For limited companies, the whole cost qualify. So when you're talking about farming, the first item that qualify for capital allowance at the rate of 50, then 25, is the farmhouse. Farmhouse is where the owner of the business stays when they visit the farm. Once they construct it, when they are claiming capital allowance, if they are doing the farming as partnership business, we are going to look at later what we mean by partnership, and also proprietorship business as a loan, they are supposed to take just a third of the cost, and that is the one that they compute the capital allowance on the rate you have talked about. However, if it is a limited company, don't take a third. Take the whole cost and give it the capital allowance at the rate that we have talked about. That was an A under the farming. So we go to B, still under farming. So I'll rate this one is a continuation of 50%. B, we are still under farming, is the cattle dip. Cattle dip. The next one, cow sheds. Fish pots. Feeding troughs. Irrigation networks. We have the water system, electricity system, and sewerage systems. All these are together as system. Sewerage. H, any other structure necessary for the operation of the farm. So when you are doing farming and you incur those costs, then know that you are supposed to claim capital allowance at the rate that we have talked about, the 50%, then 25%. Remember, that was under number 2 of the 50%. From there, we go to number 3, still under 50%. So number 3, under 50% still, we have the following items. Used or incurred in mining. So the key thing here is mining. Remember, so far we have looked at 50% and then 25% under 3 headings. So far we have done under manufacturing, we have done it under farming, and now we are in mining. So under mining, which items qualify at the rate that we have talked about? So these are, so we have cost incurred in searching, testing, and accessing minerals. So I'll list them, then I'll explain to you. We continue here, still under mining. We have B, still under mining, costs incurred in order to get rights over minerals. C, mining machine. Mining machine. D, the following buildings. Related to mining, i.e., we have staff quarters, staff clinic, staff canteen, warehouses, etc. After that, E, we have the following costs incurred before mining started. Or before mining starts. So those are the costs under mining that we normally give the rate that we have talked about. One of them is the costs that are incurred in searching, testing, and accessing the minerals. So if you are a mining company, before you start mining the minerals, you need to determine what quantity of the minerals are there. You incur the cost of searching, and then what is the quality. So you test, and then you access. Some are usually deposited underground. In that case, you have to drill so that you can be able to access. All these costs are the one that you are calling the cost that we give the rate that we have talked about, the 50, then 25%. The next one is the cost incurred in order to get the rights over minerals. As per the rules of Kenya, it says that if you buy land and you realize that there are minerals there, gold, silver, name them, you cannot start mining until you get the government permission. Government permission is usually through government giving you a license that you are allowed now and or license to start mining. So when you are getting that license, you have to pay to the government. In that case, that cost or the money that you have paid, you claim the capital allowance at the rate that we have talked about, 50, then 25. Then the other one is mining machines that are used to mine minerals. Also the foreign buildings related, the key thing is related to mining. So as long as a building is related to mining, you should give it under mining 50, then 25%. These are staff quarters, staff clinic, staff canteen, warehouses, any other building. As long as it's related to mining, then in that case you give it the rate we have talked about. Then the last one is the foreign cost incurred before mining start. The key thing there is before mining start. So if the cost is incurred after you start mining, those won't qualify. And I want to expand on that and give you a list of the expenses that are incurred before mining started. That is administration, so i.e. administration, consultancy, and management fees. So all these are expenses that can be incurred before the mining start, and all of them you are supposed to give them the capital allowance at the rate of 50%, then 25%. So those one are under the heading of mining, which was the third one. Now we go to the fourth one that still we give at the rate that we have talked about, 50%, then 25%. So number 4, we have ships, aircrafts, we have hospital buildings, hotel buildings, hospital equipment. Hospital equipments. All those are supposed to be given under the rate of 50% and 25%. And that is the end of those items that we give 50%, then 25%. So I want you to remember that 50% are under 4 headings. The first one is manufacturing, the second one is farming, the mining, and now number 4 is a composition of several items: ships, aircrafts, hospital building, hotel buildings, and hospital equipment, and it ends there. From there, there's something I want you to note about the 50%, then 25% before we go to the second rate, which was supposed to be 25%. Note. Number 1, cost of land. Cost of land and land related costs do not qualify for capital allowance. Very important that when you buy land, either to construct a factory building, to do farming, to do mining, to construct the hostel or even the hotel buildings, all these we should not give them the capital allowance at 50 or 25. Actually, land doesn't qualify for any capital allowance. We usually ignore, we don't give it capital allowance because land is always there. It does not lose value, so it's always there, so we don't give it the capital allowance. That is note number 1. Note number 2 about the capital allowance. In the factory building, in the factory or industrial building, if the following, I want to delete this part so that I can continue. If the following buildings part of factory or industrial building they are excluded when computing capital allowance. Because they are not part of manufacturing. i.e., we have offices, staff quarters, warehouses, staff clinic, staff quarters, we have etc. among others, but maybe I can add here shops, exhibition halls, among others. As long as they are not used in manufacturing, we don't normally give them together with the factory building, so that you may find that you are told we have the factory building which was constructed. So we assume this is the factory building, and we are told that it costed 100 million. But part of this, that's the whole of it that costed the 100 million. But now part of this one is used for other purposes other than manufacturing. Like you can be told this was a warehouse. This was an office. So when you are claiming capital allowance, exclude the part that are not used for manufacturing, like these ones. So you must know which cost were they. So like you can be told this one was 70 million. So in total now the office and the warehouse. So when you're claiming capital allowance on 100, it will be the one that you now claim will be 100 minus 30. 70 million is the one that you claim 50% first year, then 25% straight line basis from the second year on the remaining balance on the 70, not 100, because these parts are not used for manufacturing in that particular factory building or industrial building. That is the end of capital allowance at the rate of 50%, then 25% per annum straight line basis from the second year on the remaining balance. We go to the second rate, that is the capital allowance at the rate of 25% per annum straight line basis. So I'll have to delete this because we are done with that 50, so that now we can have the 25%. So we have the second rate.